Canadian real estate market struggles as tariff woes slow down sales in February. The problem is the sales numbers tell a different story than the headlines. Hey there, welcome back to Bald Prairie Real Estate. This week we're fact-checking the Canadian Real Estate Magazine's article talking about how sluggish home sales truly were in February. We're looking at the latest Rentals.ca monthly rent report. Of course, talking about the Bank of Canada cutting rates once again. Some stress test changes you may see later in the year and how those are going to impact you. And of course, this week's best mortgage interest rates. Canadian housing market struggles as US trade woes mount. I find this article just doesn't provide enough context to the stats they're providing. And some of them, I actually feel they may have some inaccuracies. But of course, the internet would never lie, right?
Where'd you hear that?
The internet.
And you believed it?
Yeah, they can't put anything on the internet that isn't true.
Where'd you hear that? The internet.
Oh, look, here comes my date. I met him on the internet. He's a French model.
Bonjour.
As with most real estate comparisons, they use a year-over-year stat, and the problem becomes sometimes when you don't provide any sort of context, that can lead you astray from the true reality of the situation. And that's why my monthly Canadian real estate market updates, I always use a 5-year rolling average because that tends to smooth off some of the ups and downs that we're going to be talking about here in just one second. They talk about the Edmonton real estate market having home sales down 7%. Things are really cooling off there. But if you've been watching this channel for a while, you know I've been talking how busy the Edmonton real estate market is. So who's telling the truth here? The answer is both of us are correct, but for different reasons. Yes, year-over-year home sales in Edmonton are down. The problem is without any additional context to that stat, you're missing a very important piece of information. And that is, last year in February was the second busiest February Edmonton has ever had, second only to February 2022. They had about 2,400 home sales that month, 1,900 last year, and about 1,800 this year. And the Edmonton real estate market is at a point where they're a little bit inventory constrained, meaning that there isn't enough available inventory for buyers to actually go out and purchase homes. That is part of what is holding back home sales in Edmonton right now. It's not a lack of demand pushing sales down, it's the lack of available inventory. And home prices increased 12% year over year in Edmonton. Not really sure I would call that a market that's cooling down. And if you pull up the Canadian Real Estate Association stats, now these are from last month. We've got new stats coming out next week. Really quick pause here. I record these videos typically on Thursday nights, and at the time, the February data wasn't available from the Canadian Real Estate Association. At the time you're watching this video, it is now available. I will be talking about it in next week's video. You can see that home prices have increased in every single province in Canada except Ontario year over year. When they're talking about the Montreal real estate market, they say it sees a sudden slowdown. Home sales down 11% from January to February, marking one of the largest month-over-month declines. The problem is, in January, there was about 2,800 homes sold in Montreal. In February, 4,100. Now, I'm not very good at math, but I believe 4,100 is much bigger than 2,800.
This is called adding. If I have 2 beans, and then I add 2 more beans, what do I have?
Some beans.
In reality, this past February was one of the busiest Februaries Montreal has had in recent memory. If you exclude 2020, 21, and 22, this past February was an exceptionally busy one. Now, if you are buying a house in Canada and you want an agent that actually would know those types of stats, don't worry, I can handpick a great run for you if you're not buying a house in Regina. Link in the description of this video on how to get hold of me and book me in for a consultation. Bank regulator considers replacing mortgage stress test. If you've been looking at buying a house, you have one, you already know what the stress test is. Quick refresher if you're new to here, the stress test means you must qualify on an interest rate that's 2% higher than what you were quoted or 5.25%, whichever is higher. So if you're taking today's best interest rate, spoiler alert, 3.99 on a 5-year fixed, we'd actually have to qualify on 6%. What the bank regulator is looking to do is instead of stress testing individuals like that, they want to stress test the entire bank's portfolio. So don't stress out over the stress test. You see what I did there?
Oh, okay. I see what you did there.
There's no changes right now. They're currently studying this and looking at potential changes. Likely won't see anything until later in the year. The big change you have potentially heard about is that they're going to cap out purchases at 4.5 times income. So people are saying, well, then how can somebody afford $1.5 million in Toronto? You have to remember, this is not income to purchase price they're testing. It is income to how much someone is borrowing. That is what they're stress testing, not the purchase price.
Oh my God. I get it.
For most home buyers, there's gonna be little to no change at all. But it does mean that you are now at the mercy of that bank's collective portfolio, which is gonna create a mess for those getting pre-approvals. And I feel bad for the mortgage brokers on this one, because say TD pre-approves you because their portfolio is in really good shape, but then you can't qualify with CIBC because their portfolio isn't as strong. This sounds like a great idea. Let's make this even more complicated for first-time home buyers. What you will see is an impact for those on the extreme ends of the spectrum. Banks typically have liked borrowers that have high debt loads because guess what? They pay a lot of interest over time. Those that carry very low debt loads actually might become more desirable for borrowers because they've got to add them to that pool of borrowers they have for their entire portfolio, so they can then stock up more on those that carry higher debt loads.
More like 1 out of a million.
So you're telling me there's a chance?
Yeah! Speaking of rates, what are this week's best mortgage interest rates? Finally, this week, we have an interesting week with a ton of banks dropping rates. Starting off with insurable mortgages, Radius has a 3-year for 3.99. That is a drop from last week. Looking at 5-year fixed rates, both CIBC and Radius have 3.99% available, so it's unchanged from last week. Looking at variable rates, of course, those did drop because the Bank of Canada dropped things a quarter point. The best static is through Manulife at 4.05, a drop, and the best adjustable is 4% through B2B Bank, also a drop. Now let's take a quick look at the best uninsurable mortgage interest rates. The best 3-year fixed, 4.34 through TD, that is a drop. TD also has the best 5-year fixed rate at 4.29, and that is a drop. Taking a look at the best 5-year variables, the best static 4.4 through Scotiabank, that's a drop. And First National has the best adjustable at 4.65%, that's still a drop. Taking a quick look at the big 5 banks' best 5-year fixed for an insurable mortgage, there's almost a 1% spread from the best to the worst rate. CIBC continues to be in first place at 3.99, unchanged from last week. TD jumps to second place, 4.34, that is a drop. Their uninsured rate is a little bit better than their insured rate right now. Bank of Montreal comes in at third place, 4.42, unchanged. RBC in fourth, 4.59, unchanged. And Scotiabank in fifth place at 4.84, unchanged. Another thing that hasn't changed is my terrible bad dad jokes. Why do melons have to have weddings? Because they can't elope. If you have a terrible joke I can use in a future episode, put in the comments below. Let's take a look at Rentals.ca rent report for March. Nationally, the average asking rent, according to Rentals.ca, is now below $2,100 a month. That is about a 5% year-over-year drop. Interesting enough, when you're going through the chart here, the majority of the rent changes up or down are within about 3 to 5%. Of course, if you're in Toronto or Vancouver, you probably have the ability to get some pretty decent deals, a couple of months free even, whereas in the prairies, you're still seeing rent increase. The 3 most expensive places in Canada to rent are Vancouver, Burnaby, and Toronto. The 3 cheapest places to rent in Canada right now, Fort McMurray, Regina, and Saskatoon, respectively. Let's dive into the Canadian Bankers Association monthly report on mortgage arrears rates. The Canadian Bankers Association data here includes all of the big 5 banks and a bunch of the monoline lenders. It doesn't include credit unions, but their numbers are almost identical to the banks. It also doesn't include the private lenders, and those do have higher mortgage arrears and delinquency rates, but they build their business model expecting that to be the case. You've probably seen some pretty interesting headlines about how mortgage arrears continue to skyrocket. That is very misleading. They've gone from 0.21% to 0.22%. A grand total of 400 more mortgages are in delinquency this month versus last month, of 5 million mortgages. Right now in Canada, we have about 11,000 mortgages that are delinquent. That means they're 90 days or more behind. So this data is as of to the end of December 2024. Interestingly enough, it actually results in a smaller year-over-year increase from the previous month, because last year around this time, we saw a larger month-over-month increase in delinquencies. I always assumed you'd see a large jump in delinquency December to January, but actually when I was digging through the data, the biggest jumps typically happen November to December instead.
What will be the impact on the Canadian real estate market based on the Bank of Canada's most recent rate cut?
This question originated on my video last week about the impact of Trump tariffs on the Canadian real estate market. And by itself, I don't see a 25 basis cut having a major material impact on the real estate market. It only changes the average mortgage payment by about $75 a month. And of course, only for those that are on variable rate mortgages. For those come at renewal, this makes that renewal a little bit easier to stomach. You're probably renewing into a higher interest rate, just slightly lower now. And remember that about 75% of Canadians are on fixed rate mortgages. So for them, it doesn't impact them at all right now. I do think though that the overall market sentiment, people are seeing interest rates continue to go down. We've seen 7 rate cuts in a row from the Bank of Canada. A lot of expectation that will probably continue. I get it, a lot of uncertainty right now. But as the overall sentiment shifts with that mindset that rates are going to either continue to drop or kind of stay where they are, probably entices a few people off the fence. I don't buy into the argument there's all this pent up demand just waiting for a couple more rate cuts and then they'll jump into the market. But it does kind of shift the overall mindset.